Taking a look at last week's markets, it was OPEC Plus who served up the biggest shock, making a surprise announcement that its member states will cut oil production by 1.2 barrels a day, or just more than 1% of global supply, starting next month. It comes as the cartel seeks ways to up prices, and while the move initially jolted the market, prices have somewhat stabilized, although it remains up more than 25% from the lows we saw mid-March. The decision could possibly further hamper global economic growth efforts while also increasing inflationary pressures, and this is particularly concerning as it seems like the past year's interest rate hike cycle is starting to have its effects on economies, particularly in the US. The non-farm payroll data released on Friday shows an additional 236,000 jobs were added in March. So although the American economy has remained robust, the rate at which employment is being added is slowing, and this then points to the hiking cycle working its way through the economy. It also corresponds with other US data released last week, like the ADP employment data and the ISM services index, all revealing the cooling effects of the higher interest rates in the US. The data further strengthens the argument that the Fed may be approaching the end of this hawkish cycle. Looking at the relationship between unemployment and US interest rates, it's clear the turning point could be near. Meanwhile, at the other end of the world, things seem to be rebounding in the Chinese economy, albeit from a low base. The latest Caixin Services PMI rose to levels last seen in November 2020, and the rebound is being driven by services activity and government investment in infrastructure. Should China's economy continue on this recovery trajectory, it will undoubtedly lend support to global growth efforts, while also having a significant impact on commodity demand. Data released early Monday morning shows inflation eased in China in March to 0.7% year on year, while PPI inflation contracted by 2.5% year on year. This then leaves room for the Chinese government to implement supportive policy measures, as inflation is unlikely to get out of hand. China also featured on the geopolitical front, as it was the EU's turn to try and woo Xi Jinping last week. Jinping held talks with both the European Commission President Ursula von der Leyen and French President Emmanuel Macron, as the bloc seeks to secure ties with China, who is the largest source of EU imports. Macron, according to reports, says he used the opportunity to push for China to act as a mediator for peace in the ongoing Russian invasion of Ukraine. Meanwhile, in a move considered to have further strained relations between China and the US, Taiwan President Tsai Ing-wen was jetted to California as, quote, a great friend of America. Ing-wen held high-level talks with House Speaker Kevin McCarthy. Now, this meeting reportedly further ruffled feathers in Beijing, who course, lays claim to Taiwan. It's these simmering tensions between global powers that have the IFM warning of so-called friend-shoring. The monetary body has noted an increase in the flow of direct investment between those countries who are geopolitically connected. And while this may make some sense on the political front, the lack of diversity could amplify risks associated with an economic downturn, like a possible recession in the US. Back in South African soil, there were no major data releases. Eskom, however, continues to dominate discussions. The government revoked the state of disaster over the energy crisis as it faced several legal challenges over the decision. The state further got lambasted over its decision to exempt the energy giant from reporting in its annual financial statements on wasteful and irregular expenditure that did not arise from corruption, as required by the Public Finance Management Act. National Treasury is now in discussions with the Auditor General and Eskom's auditors on how to reframe the Gazette while tightening the checks and balances. It also comes as consumers will continue to bear the brunt of Eskom's failings, with the latest data from the utility showing that we can expect load shedding every week for the next year. Meanwhile, the private sector seems to be filling the energy gap as Eskom's available energy supply continues to nosedive. The private sector has been ramping up generation to mitigate the impact of rolling power cuts over the corresponding period. And as load shedding continues to weigh the South African economy down, the World Bank came out last week warning that the country, along with Nigeria, is damaging growth in sub-Saharan Africa and could result in a decade of lost growth due to their underperformance. It wasn't all doom and gloom, though, as SARS's efforts to clamp down on tax avoidance has seemingly paid off. It had collected 2 trillion rand over the past year, and while impressive, tax refunds surged by almost 19% year on year, totaling 381 billion rand. Looking at the week ahead, the IMF spring meeting is set to kick off in Washington this week. Discussions on the rising inflation and impact of higher interest rates are set to dominate, while further talks are expected on how global leaders are going to fund climate mitigation strategies. South Africa is also sending a special envoy to the US in an attempt to discuss the country's position over the Russian invasion of Ukraine. It's also understood the appointed persons will be fighting to safeguard billions in trade between the two countries through the AGOA agreement. On the data front, the South African manufacturing production for February is scheduled for release on Tuesday. The industry has struggled to regain traction following the pandemic, as load shedding, along with port inefficiencies, are weighing the industry down. Production remains around 8 to 10% down from pre-virus levels, and ETM expects a further contraction of 3.7% from the February data. Similarly, mining production remains in a tight spot. Its latest production data will be released on Thursday, and although the industry has remained resilient, boosted, of course, by the raised commodity prices, there are signs these benefits are now fading. Our view is that production in February may have improved year on year, largely due to a statistical comparison against a weak base a year ago, but the sector continues to face several headwinds. On the international front, analysts are expected to closely monitor the release of March's CPI in the US, with a particular focus on core inflation, which has remained sticky despite the tighter monetary conditions. ETM anticipates inflation to slow further to 5.2%, down from 6% in February. And this, along with the Fed's minutes from its March decision, will be closely monitored for any possible hints on the trajectory of interest rates. Meanwhile, the US's March PPI figure will also be closely watched on Thursday. As this is a leading indicator, it provides insight into how prices may change at a consumer level. While the expectation is that the PPI is further slowed in March, OPEC's recent decision remains an inflation risk going forward. And we end off with a quick look back on the Rand's performance last week. The currency continues to be swayed by the current phase of negative sentiments in South Africa Inc. The weak performance was further exacerbated by last week's shortened week due to the Easter holidays. And it should be noted that recent data points to significant outflows from South Africa's equity market in recent months, which could be investors adjusting for load shedding, as well as the country's recent grey listing. And although there is little indication of the Rand making any significant recovery anytime soon, ETM believes that the currency will recover in the medium-term outlook, providing opportunities for exporters to capitalize on the value on offer by locking in forward rates. That then a quick wrap of what has been and what's to come for the markets this week.